Hello, and welcome to this podcast for investors that focuses on the impact of the new revenue standard on the airline sector. I'm Jeff Brickman, Senior Investor Liaison at the Financial Accounting Standards Board. Thanks for joining us. With me today are FASB Board Member Mark Siegel and FASB Practice Fellow Jason Bond. We will provide a brief overview of the revenue model along with some sector-specific impacts that we expect for the airline sector. Throughout the discussion, we will have slides you can follow along with that will include some of the key points related to those impacts. But first, before we begin, I'd like to remind everyone that the views expressed in this podcast are the personal views of the participants. Official positions of the FASB are reached only after extensive due process and deliberations. So let's get right into it. Mark, can you kick us off with a quick primer on the new revenue model?
Sure, I'd be happy to, Jeff. First, let me just say that we're very interested here at the FASB in trying to help facilitate investors' understanding of the revenue recognition standard. So we thought it would be timely to hold this podcast now, since companies will be implementing the new standard next year. Hopefully, this will help investors understand the impact on airlines and identify questions that they might want to ask companies about their specific facts and circumstances. Prior to the recording of this particular podcast, we've held Q&As with executives at companies in several other sectors. For those following the aerospace and defense companies, or software companies, or those who are doing SaaS, please look for archive recordings of those webcasts on our website at www.fasb.org and go to the section on educational resources for investors. So as you'll see on slide 2 here, the new revenue standard has an overarching framework to recognize revenue. It applies to nearly all revenue from contracts with customers, except for a couple of areas where there are other models in GAAP already, like for insurance companies or leases or for banks. The guidance is generally converged with IFRS, so most public companies around the world will be following the same set of rules going forward. The new standard has 5 steps to recognize revenue, which are shown on the screen here. A company will evaluate its contract with a customer to make sure that there's a real substantive contract. It will then identify the promises it has made to that customer as part of the contract and which of those it should account for separately. Then it will determine the overall purchase price, which we call consideration, that it expects to receive for all of those promises, including any estimates of any variable amounts. A company will then allocate that total amount of estimated consideration to each of the promises that have been made to the customer that you identified back in step 2. Finally, the last step is that it will recognize revenue either at a point in time or over time as the seller satisfies the promises that it made to the customer. So the impact of this standard is going to vary from sector to sector. In fact, even within a sector, it's going to vary potentially from company to company. Now, the reason it could vary from company to company, even in the same industry, it's partly because not all contracts within the same industry are economically similar. And also, the impact of the new standard will be directly related to how a company is recognizing revenue today. So to the extent a company has a different revenue recognition approach today than one of its peers, the change that those two companies have as a result of the new standard might also be different.
That's helpful, Mark. So Jason, what are some of the expected impacts of the new revenue standard for the airline sector?
Jeff, there are a couple significant impacts for this sector that we wanted to highlight on the podcast today. However, as Mark just mentioned, the impact of the new standard for different airlines might be different based on how each airline is accounting for these items today. The first impact, on slide 3, relates to airlines' loyalty points, or airline miles as people often call them. Today, airlines follow one of 2 methods to account for their airline miles, either the incremental cost method or the revenue deferral method. Under the new revenue standard, the revenue deferral method is required. So airlines that follow that method today should not have a change in the timing of revenue related to the airline miles after they adopt the standard. Under this method, the airline allocates a portion of the ticket price to the airline miles based on the relative value of the miles granted for that flight. The portion of the ticket price allocated to the miles is deferred and then recognized when the customer uses the miles. Those airlines that follow the incremental cost method today record a liability at the time the passenger earns the miles for the incremental cost of providing the future benefits that can be redeemed for the miles. Because the incremental cost is accrued and expensed when the miles are earned, there is no effect on revenue or expense when the free flight is taken. This method will no longer be permitted under the new revenue standard.
That makes sense, Jason. So essentially, the new revenue standard will eliminate the differences between companies in how they account for airline miles today. It seems like regardless of the approach a company takes today, it has a liability recognized, either a cost accrual or deferred revenue. Will the amount of that liability change for an airline that will need to move from the incremental cost method upon the adoption of the new revenue standard?
That's a good point, Jeff. Under the revenue deferral method, the ticket price is allocated to the miles based on their standalone selling price. The standalone selling price of the airline miles will need to be estimated, for example, based on the redemption value of the mile. This estimate will require significant judgment. The liability under the incremental cost method may be based on the incremental cost of providing a future flight. Since many of the airline's costs are fixed, the liability recorded for the mile under the incremental cost method likely is significantly lower than the standalone selling price of an airline mile. We've observed some airlines disclose that the increase in the liability under the new revenue standard could be several multiples higher than the liability previously recorded under the incremental cost method.
So Jason, that could be a material change for some airlines.
Yes, it could be.
Mark, are there other areas that you've heard about for the airlines that could see a significant impact upon the adoption of the new revenue standard?
Yeah, another significant impact relates to ancillary services and change fees, as shown on slide 4. So the ancillary services include items like baggage service, priority boarding services, pre-assigned seating, food and entertainment. Under the new standard, most of those ancillary services will be recognized together with the flight revenue. So this is not likely to change the timing of the revenue recognition for most of these fees because most of the services are provided at the same time as the flight. However, several airlines have disclosed that revenue from these services will be presented in passenger revenue and will no longer be presented as other revenue. Investors will need to consider this change when they evaluate key metrics used in the industry, such as passenger revenue per available seat mile after the adoption of the new standard.
So for ancillary services, it seems that total revenue each quarter will not be altered in most cases, but the presentation of the revenue and possibly related metrics will be different. That's definitely something to be aware of. You also mentioned change fees. How will those be accounted for under the new standard?
So this could be a change from today for some folks. Under the new revenue guidance, when a passenger changes a flight and pays a change fee, the airline does not provide any additional goods or services to the customer. The airline's promise is still a flight, just like it was before. As a result, the change fee will not be accounted for separately and will be recognized as revenue with the ticket price when the passenger takes the flight, which is actually what satisfies the promise to the customer. So this is going to be a change for those airlines that today recognize change fees when they're charged.
So unlike the ancillary services, there could be a difference in timing of revenue for change fees under the new standard. Mark, is that correct?
Yeah, that's right.
Jason, I know there was one additional area that we wanted to address in today's podcast. Can you walk us through it?
Sure, Jeff. The last impact we wanted to address is on slide 5, the accounting for unused tickets or flight credits. If I cancel a flight that was previously purchased, the airline will typically issue me a flight credit that needs to be used within a certain time frame. We understand that airlines typically expect that a portion of these flight credits will not be used by the passenger and will expire unused. This is commonly referred to as breakage. Today, airlines account for the portion of the flight credits that expire unused in one of two ways. Some airlines recognize revenue for the flight credit when it expires. Other airlines estimate the amount of the flight credit that will go unused and recognize that amount as revenue proportionately as the portion of the flight credit that is used is recognized as revenue. Under the new standard, if an entity expects to have breakage, which is common in the airline sector, the airline must estimate the amount of breakage it expects and recognize that amount as revenue proportionally as the rest of the flight credit is used. This is consistent with the second method that I just described. Airlines will not be able to wait until the flight credit expires to recognize revenue for the unused portion, assuming they expect some amount of breakage.
Can you give us an example of how that works?
Sure. We have laid out an example on slide 6. Assume an airline issues me a flight credit of $4,000 for a business class flight that I canceled. Based on its historical experience with similar customers, the airline estimates that I will not use $800 of that flight credit. Today, some airlines will recognize $3,200 of revenue as I use the flight credit, and then recognize the $800 unused flight credit when that credit expires. But that will no longer be permitted under the new standard if the airline expects breakage. The airline will need to recognize the $800 unused flight credit proportionally as the $3,200 is used. So for every dollar that I use of the flight credit, the airline would recognize $1.25 of revenue. Under this method, the airline will have recognized $4,000 of revenue when I have used $3,200 of the flight credit.
Thanks for that example. Mark, I know that one of the benefits to investors of the new standard is the increased disclosures that companies will need to provide. Can you share what some of those new disclosures will include, and also, when will companies be transitioning to this new standard?
Sure. So the new standard includes a whole disclosure package as shown on slide 7, and it was developed with a lot of input from investors to provide more information about a company's contracts and revenue it has recognized, including disaggregated or broken down revenue information. The disclosures will also include information about significant judgments and estimates, how and when the company recognizes revenue, and information about revenue that is yet to be recognized from contracts that are in place at the end of each quarter and year, which is similar but not necessarily the same as a backlog disclosure that might be found in the press release outside of financial statements. So now in terms of transition, slide 8 illustrates the requirements. Public companies are required to adopt the new requirements in fiscal year 2018, beginning with the first quarter. Public companies are permitted to adopt the standard early whenever they want in 2017 if they like. However, based on a review of the disclosures of the major U.S. airlines, we're not aware of any airlines that have adopted or plan to adopt the standard early. The standard includes 2 transition methods for companies to apply, but irrespective of the transition approach that a company takes, it will have to provide some degree of comparative information to its investors. So you will be able to understand the impact of the new standard on a company's revenue during the first 4 quarters of the year that the standard's adopted.
Mark, do we have a sense for which transition method the airlines will use?
So airlines, as well as most public companies, have provided disclosures in their 10Ks and 10Qs, and those discuss their implementation plans and any expected impact of the new standard on their financial statements. So based on the SEC filings that we have reviewed, it looks like the major U.S. airlines currently are planning to adopt the standard using the full retrospective transition method. And if that is the approach they ultimately take, then what you'll see in their Qs or Ks after they adopt, all quarters or years will be as if the new revenue standard had been applied in each interim or annual period. So in other words, 2016, 2017, and 2018 financial information would be presented under the new revenue standard.
Thanks, that's helpful. It's important for investors to keep in mind that today we've discussed some of the bigger changes we've heard about, but it's possible there are other changes for a particular airline. Investors should keep an eye out for any language about the expected impacts of the standards in the Ks and Qs of the companies they cover. To wrap up this podcast, I'd like to take a moment to discuss some of the key takeaways and observations from the conversation. First, investors will need to understand how an airline accounts for airline miles, change fees, and unused tickets today before they'll be able to understand the impact the new standard will have on a specific airline. Companies are permitted to take different approaches today, so the impact of the new standard will vary from one company to the next. Second, there might be some differences in the presentation of revenue in the income statement, so investors should look out for those when calculating performance metrics. Third, although some of the differences in accounting between companies we see today will be eliminated upon the adoption of the new standard, airlines will need to exercise significant judgment to estimate the standalone selling price of airline miles and the percentage of tickets and miles that will expire unused. Those estimates can be highly subjective. The new revenue standard requires a company to disclose information about the significant estimates they make, so those disclosures should provide additional useful information for investors related to those estimates, including how the estimates change over time. Thank you for joining us with this podcast. If you found it useful, we recently participated in a sell-side sponsored webcast on how the new rules about lease accounting will impact retailers and airlines when it becomes effective in 2019. That webinar can also be found at www.fasb.org in the Investors section. Additional information, including all of our contact info and further details on the new revenue standard, can be found on our website.